Hello and welcome to our video lecture for Chapter 4. In this chapter, we are talking about internal control and cash. First, let's discuss fraud. Fraud is an intentional misrepresentation of fact that does cause some type of injury or damage. The most common types of fraud, I would say, are credit card fraud and identity theft, although the other types are also prevalent. The two types of fraud that have the most significant impact on the financial statements are misappropriation of assets, which is basically with the theft of money or inventory. Usually cash and inventory are the two most predominant assets that are taken. You might also get some bribery or kickback schemes. For example, if you give business to a particular vendor, you might get some money for it, which is not adequate. And then the most common type that most people commit is an overstatement of expense reimbursement. The example here would be maybe you get a cab receipt and you put it in for $50 when you truly only spent $20 on the cab receipt. So that's another type of fraud. Fraudulent financial reporting is usually committed by managers, usually the CFO, controller, maybe in collusion with the CEO. And here you're actually putting journal entries on the books that are false and usually to deceive investors and creditors. The fraud triangle is one of the most important aspects of fraud, and there you need motive, opportunity, and rationalization. The motive is you feel that you are underpaid or you're having financial troubles or you're in over your head in debt. That could be a possible motive. The opportunity, you are in a position where you can actually take the inventory or take the cash, and the rationalization might be that you feel comfortable doing so because, hey, the company is undervaluing me. I should get paid a lot more money. So if they're not paying me, I'm going to take the money anyway. So these are just some of the examples of the fraud triangle. This is a critical piece of fraud and something you should remember. So I'm going to put a star here so you can make note of that. Now moving on to what you do in terms of the components and objectives of internal control to hopefully prevent, detect, and correct fraud. Preventive measures are the most. Internal controls are in place to hopefully prevent any errors or fraud to occur. Normally, management or the board of directors basically has a plan, and then they have procedures in place of internal controls to hopefully do this piece. So the objective is you want to make sure that your cash and or assets, inventory and cash are safeguarded, that employees follow the policies and procedures that you make in order to promote operational efficiency, and hopefully the internal control and the employees following them promote that to ensure that your accounting records are accurate and that you're complying with all the legal requirements that you need to. So Sarbanes-Oxley is SOX, so Sarbanes-Oxley Act, and this was enacted in 2002, which now states public companies. So if you trade stock or shares of stock on some type of exchange, then you are publicly traded. You have to have a system of internal controls, and more importantly, you have to issue a report on it. Usually the auditors have what's known as an integrated audit. And what that means is you audit the financial statements and the internal controls, and this report on the internal controls is pivotal. The PCAOB, Public Company Accounting Oversight Board, is the regulatory body that pretty much tells auditors what to do, similar to FASB and GAAP, leading our financial reporting and financial statements. And one of the key elements that the PCAOB enacted based on Sarbanes-Oxley is that auditing firms, we have four, we call them the big four auditing firms: E&Y, Ernst & Young, D&T, Deloitte & Touche, PwC, PricewaterhouseCoopers, and KPMG, Pete Marwick. These are the big four accounting firms, and what they can do audit and tax services, but they cannot do consulting services. Prior to the enactment of SOX, they could do all of these issues, but then we had Enron and WorldCom and Sunbeam, and these were all, you can Google them and you'll see these were all Arthur Andersen's debacles in auditing. So then these internal controls will hopefully eliminate or prevent fraud, waste, and any inefficiencies. And then these procedures are kind of put on top of the information system, but the key is monitoring. So let's look at the control environment. Basically, the employees at the top set the tone, and you might have a code of ethics or a code of professional conduct. And this control environment, basically you're identifying the risks where people could actually go wrong, and then you're establishing procedures or the internal controls that, hey, this is an issue, so if we issue this control, it would hopefully prevent that. We do that in information systems where we can capture the whole process and the transactions and then report upon them. And the control procedures, we kind of put that over on the information system. So these are the internal controls are kind of placed on there. But as I mentioned, you need to monitor those controls, and not only by the internal and the external auditors, but you need to make sure that they're doing what the company expects it to do. So some internal controls that you can do is basically when you're hiring people, maybe do background checks, maybe check references of the person to make sure that you're hiring, train them properly, give competitive salaries so you're hiring the best of the best, have clear job descriptions so employees know exactly what they need to do. The most common and most used internal control procedure is segregation of duties. Now, with segregation of duties, what we're doing is we're saying that these three functions, so asset handling, record keeping, and approval, are separated. So the person who deposits cash in the bank is not the person who records their journal entry and is not the person who approves their journal entry. This would be done by three people. We call this checks and balances, and that's the whole premise of accounting, basically. One person does the deposit, another person records the journal entry, and a third person approves it to ensure that everything is done properly. Then you might also compare and monitor. So you might have cash and operating budgets, and we are going to do some cash budgets in this chapter. You might also compare actuals to budget. You might compare actuals to forecasted numbers. You might do exception reporting. Hey, there's a problem here. Let's print out a report and see what happened and see if you can build an internal control around it. Audits, and you might also do compliance audits. Instead of just internal and external audit, are the employees complying with the internal control procedures in place? You might also have adequate records. So you might have, like, each journal entry is supported by the proper documentation, whether it's hard copy or electronic. Pre-numbered documents are also very common. You might do this for purchase orders or POs. You might also do this for invoices, so that way employees can't override the numbers, and by doing that, then the next process gets into place. Limited access, right? So you might not have access to all the assets. You might have inventory under lock and key. You might have mandatory password changes and encryption. A lockbox system is where the money is deposited directly into a lockbox. So what happens here is you might get to send it to this particular P.O. box address. That address is more like just a P.O. box. The bank goes, takes those checks, deposits them directly into your account, and then sends you electronically or through snail mail the backup remittance advices. That limits access because that's going directly into a system. It's to a box, and then that box is controlled by the bank, and then it just gets directly deposited into your account. Then you might have proper approvals, right? So if you have a management approval, if they get it, was that overridden? And if so, what happened? A credit department, this is usually done in accounts receivable, right? So you have a customer and maybe you granted a customer $100,000 worth of credit. So did they actually go ahead and get that done? Can the customer pay for it? A purchasing department, this would be mostly for POs. HR, are they hiring employees and hiring them at the correct salary? And then we have our information technology. So here what happens is accounting is a more IT process. It is no longer manual, right? We actually book journal entries, possibly in a CSV, a comma separated value file, or like a text file where you can upload them directly into the accounting information systems. Accounting information system. AIS. And so basically with the use of computers, we're able to greatly improve our speed and accuracy. So now we have safeguards and controls. Mandatory vacation, especially for accounting personnel. That way somebody else does the job for a week and see if there's any ways you can improve them, and also if there's any types of fraud going on, you can detect them. Job rotation, we call that basically where you're having other employees do on someone else's work. You might have security cameras and alarms on there. You might have fidelity bonds, which kind of say, hey, this will help you through that process. Then internal controls, right? Some of the problems that happen with the e-commerce or like online buying, you might have your credit card number stolen, you might download viruses. So some ways in which organizations do that is they have encryption, they have validation that your credit card will be securely encrypted, they have firewalls so people can't get into them. Then the benefits of internal controls and basically costs and benefits. The benefits should be greater than the costs, right? Cost-benefit analysis, as we call it in accounting. But ways that you can kind of circumvent the internal controls: collusion, right? That segregation of duties, remember that? So where you're actually separating job functions, well, here you have collusion. Two people get together, and then they go ahead and that separation is gone because they're both committing the fraud. If there is a management override, that's where that exception reporting comes in. And that exception reporting says, hey, why did this override take place? So this is where we're going to stop this video lecture, and then we are going to continue with our next learning objective in the next one.